So we just witnessed the second largest bank failure in United States history. Silicon Valley Bank in San Clara, California was closed on Friday by the California Department of Financial Protection and Innovation. And at the time, they were the 16th largest bank in the nation with over $201 billion in assets. So here's what really happened, and here's what to expect if you're one of their customers. First, I want you to think about the process you typically go through whenever it's time for you to make a financial decision. You probably think about all the pros, the cons, and even what risk can come up and what will be the worst case scenario. And usually whatever gives you the most upside potential but at the same time gives you the less amount of risk is the direction you'll head in. Especially if the majority of the risks require multiple things to go wrong at the exact same time. In your mind, you're thinking, what's the odds of all that happening at once? And unfortunately, this is exactly what happened to this bank. So I want to take a quick dive into exactly how banks work. So they operate on a system called fractional reserve banking. All that means that when you make a deposit to that bank, legally, they're only required to keep a fraction of that money on reserve. And that number ranges from 3% to 10%. So for every $100 they get in deposit, they're only required to keep either $3 or $10 on reserve, which in turn means they can either invest or loan out 90 to 97 of your dollars to someone else. So in a nutshell, banks pretty much always operate with a liquidity risk, which for the most part works out fine for them, just as long as there's not other risk factors that come up as well. One thing to keep in mind when it comes to this particular bank is they don't have the average retail client. Most of their clients were either tech or venture capital companies, and also some executives that work for the company too. And unfortunately, their relationship with all these tech companies start to become a liability for them. Mainly because tech stocks have been getting hammered for the last 18 months, and they've had a lot of layoffs spread throughout the industry. But that's their main client base, so they had to maintain that relationship. So in an effort to try to attract more clients, what the bank did is they offered higher interest rates on deposits than any of their other competitors were. Because most people are going to want to bank with the bank that's going to give them the most opportunity for growth on their money. So in order to fund these higher rates they're offering their clients, what the bank did was they bought bonds with a lot of the cash that they had on hand. And here's where things start to get worse. And back when interest rates dropped to nearly zero, the bank loaded up on long date, seemingly low risk treasuries. And here's where things start to go bad. When the feds begin to raise interest rates in order to fight inflation, the value of those assets begin to fall. Because bonds have an inverse relationship with interest rates. This means when interest rates go up, bond prices go down. And when interest rates go down, bond prices go up. And remember, they bought when interest rates were down, but now interest rates are high. So you can see how timing is definitely not working out for this bank right now. So in this situation, they bought those bonds when interest rates were down, meaning they paid a lot of money for them, versus now interest rates are high, so what they bought high is now worth less. But even with that being said, typically this still wouldn't matter because that's what's called unrealized loss. That just means the loss is on paper because it doesn't become a real loss until you actually sell that investment. And on top of all that, the higher interest rates also affected the tech industry. So what it did is it undercut the value of their stocks, making it harder for them to raise funds. And now since these tech companies can't raise funds, what they have to do is start pulling out their assets out of the bank so they can run their operations. And just when you thought it couldn't get any worse, it does. Remember, this bank isn't dealing with the typical $100 withdrawal here, $100 withdrawal there. These withdrawals are significant because these are tech companies. And when these tech companies start withdrawing so much money, it completely threw off the bank's balance sheets, which means they're running out of their cash reserve. So for the bank to get more liquid capital, they had to start selling a lot of those bonds they had purchased. And on Wednesday, they announced that they had sold $21 billion of their bonds at a $1.8 billion loss, along with a plan to sell $2.25 billion in new shares. Now here's where the fear starts to roll in. Once their current customers got wind of what they just did and what they plan on doing, they start moving a lot of their money out that bank. Customers tried to move $42 billion from the bank just on Thursday alone. And that's a quarter of the bank's total deposits. And of course, that scared off investors, and as a byproduct, the bank plunged 60%. The flood of all those withdrawals completely destroyed the bank's finances. And at the close of business on Thursday, they had a negative cash balance of $1 billion. And they couldn't even cover their outgoing payments. So at this point, all the boxes of what could go wrong were all checked. And this is when regulators jumped in and completely shut the bank down. They immediately appointed the FDIC as the receiver. And to protect the insured deposits, the FDIC created the Deposit Insurance National Bank. And they transferred all the insured deposits over to that new bank. The FDIC posted this on their website. All insured depositors will have full access to their insured deposits no later than Monday morning, March 13, 2023. The FDIC will pay uninsured depositors in advance and dividends within the next week. Uninsured depositors will receive a receivership certificate for the remaining amount of their uninsured funds. As the FDIC sells the assets of Silicon Valley Bank, future dividend payment may be made to the uninsured depositors. And when they refer to uninsured depositors, they mean anything over $250,000 because that's the max that the FDIC insures for. Now the problem with that is that a recent 10K filing shows that over 90% of the funds are uninsured. So if they have $209 billion, that means 188 is uninsured. That's a horrible situation. It's going to have a huge impact on all these companies that do business with them. But as of now, we have to wait and see what happens. But if you are one of those uninsured depositors, the FDIC recommends you reach out to them immediately. I'll put their information in the description box below. And as of now, other banks haven't been affected by this, but I would definitely start paying a lot more attention to any banking institution that holds more than $250,000 of your money. You may want to start thinking about spreading that money out to different banks or different credit unions. Hope this helps. I'll make a video with updates as they come up. Don't forget to hit the like button, subscribe to the channel, and I will see you in the next video.